You no longer have to compromise on managing your private wealth. Now you don't have to choose between growing your portfolio or shrinking its carbon footprint. You can do both. You don't have to choose between enriching your own life or ensuring your family's future. You can do both. Or between the trusted service of a local firm and the global access of a multinational. You can have both. Because LGT Crestone gives Australian private wealth investors the best of both worlds. Visit lgtcrestone.com.au.
Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here at Ausbiz. Checking what happened on global markets overnight. Modest moves as investors wait on more economic data. European shares, they ended lower, while on Wall Street the S&P 500 and Nasdaq edged higher to new records. The market is waiting on the minutes from the Fed's most recent policy meeting, as well as those results from Nvidia, which are due to drop late tonight, our time. Now, the other mega caps to move included Tesla and Apple, which has extended its rally over the past month to more than 15%. The retailers came under some pressure, with Lowe's shares falling after the home improvement company warned of operating margin pressure in the current quarter. Automotive parts retailer AutoZone fell after a third quarter sales miss. However, Macy's jumped after the department store chain raised its annual profit forecast despite posting a bigger than expected drop in sales for the first quarter. JP Morgan Chase recovered some of the previous session's losses, pushing the S&P 500 Banks Index higher. And IBM rose on plans to release a suite of artificial intelligence models as open source software and help Saudi Arabia train an AI system in Arabic. Well, in the latest Fed speak, Governor Christopher Waller saying that further interest rate increases are probably unnecessary. And in terms of cutting rates, he said if the data were to continue softening throughout the next 3 to 5 months, you can even think about doing it at the end of this year. Atlanta Fed Chair Raphael Bostic saying the Fed needs to be cautious about approving its first rate cut, saying the existence of this potential exuberance means that we have to be very cautious about when we do that, the first move, and it may mean that it has to happen later. Well, US Treasury yields have dipped ahead of the minutes from the Fed's latest policy meeting, with investors looking for any fresh clues on when the easing cycle is likely to begin. The 10-year yield was at 4.41% and the 2-year at 4.83%. And Canadian inflation in April rose 0.5% month on month and 2.7% year on year, in line with forecasts, opening their way for an interest rate cut there as early as July. The US dollar, meanwhile, has strengthened slightly. The Aussie is trading at 66.7 US cents. Well, for more on those macro moves, particularly with a focus on what we're seeing with that economic strength in the States, I caught up with Anwiti Bahuguna from Northern Trust Asset Management.
The US economy is showing incredible signs of resilience, given the fact that we've had 525 basis points of monetary tightening over the last couple or so years. And you've seen that resilience very much so in the last 2 quarters, where growth has been well above trend. We anticipate that growth trend to continue, perhaps not at the red hot levels that you've seen in the last 2 quarters, maybe slowing down a little bit. And to your question, we are seeing some signs of a little slowdown. So a couple of examples I can point to are that payroll growth last month was a little less than before, which is a good sign. We don't want overheating in the economy. And on the lower end of income quintiles, we are beginning to see some pickup in delinquency.
What are you seeing with the labour market? That appears to be key, doesn't it? That once again, that is proved to be extremely resilient.
Yes, there is a lot to unpack on the labour market front. So I'll start with some of the key indicators we look at. So obviously I mentioned the payroll report. The payroll data is still very strong. It's well north of 200,000 jobs added every month. That's well above the replacement rate needed in the US economy. But we're getting a little help, Andrew, from immigration on that front. The other thing I would point out on the US labor market front is that jobless claims are still very low. And as long as we see claims staying low, which means unemployment stays low, we continue to see a strong labor market. We continue to see a strong consumer, because that pretty much is driven by this low unemployment rate. And then I will add one more point, if I might, on one of my favorite metrics, which is the quits rate in JOLTS data, Andrew. And this is, an arcane little thing that we look at all the time, which tells us at what pace people are quitting their jobs. And that is a indicator that correlates very well to what happens to future wage growth. That quit rate is coming down. That means that we expect wage growth to come down a little bit more. And I think that'll be well received by the Fed and by the markets, because that's one of the key drivers of inflation, or one of the fears about the key drivers of inflation in the US economy.
Well, given that economic backdrop you've just outlined there, Anwiti, what then is your expectation as far as when the Fed is likely to cut? I noticed, in fact, just overnight our time, Fed Governor Christopher Wallace saying another increase is probably unnecessary. So what's your base case there?
It is lovely to hear them say that increase is unnecessary, because our base case is that they will cut rates. I expect them to cut rates maybe 2 times this year, towards the later half of the year, as they gain more confidence in inflation data moderating, and they haven't had that come out very strongly, but a combination of further moderation in wage growth, further moderation in inflation, which is our expectation, should help them make the case for 2 cuts towards the end of this year. I would say that from the market perspective, 1 or 2 cuts, both are all good news. I think it's really good to hear that they are not anticipating further hikes. And that is the risk case that we worry about. And it doesn't matter if it's in September when they cut, or whether it's November. As long as the easing cycle is starting, that is good news for the markets.
Well, speaking of good news then, Anwiti, certainly equity market taking it that way, seeing obviously that strength in the economy and the prospect of interest rate cuts coming. How are you viewing the outlook then for, in particular, US equities, given those valuations at the moment?
Valuations are absolutely something we focus on very, very much. I would say that there are 2 components to it. One is the price component, the other is the earnings component. And we are just coming off the first quarter earnings cycle. And as we see the results from that, it's becoming clear that we are seeing resiliency in earnings also. Earnings are improving. Expectations are for better earnings over the next 12 months. That is the backbone of sort of the strength of the US market. And even though valuations are high, that continued strength of consumer, continued strength in the earnings number, improvement in sort of the monetary policy picture over the next few months keeps us constructive on US equity markets. And I would say that earnings is not just coming in better than expected, but earnings breadth is improving. So one of the worries in the market was about concentration in just a few stocks, and we're seeing improvement in market breadth, which keeps us constructive.
So in terms of portfolio allocation, perhaps with a global perspective, Anwiti, what do you think is an appropriate balance at the moment?
Right. I think it's important to think globally. I think US earnings and US growth is good, but we are now seeing broadening of that global economic picture. So, for example, PMIs are improving across the globe. We had good services PMIs always, but now we are seeing improvement in manufacturing PMIs also. So that's happening in Europe, that's happening in Asia. That's keeping us actually constructive on global equities. We have recently raised allocations to developed market equities as well as emerging market equities.
And so in terms of fixed income, are you sort of proving, when you, I guess, base that with also equities, you're sort of lightning in that case, are you?
We are modestly underweight fixed income at the moment in order to sort of fund our overweight equity allocation. And within fixed income allocations, we have an overweight to higher yielding bonds. Investment grade bonds that spreads are incredibly tight, which is also the case actually for high yields also. But in the event of modest uptick in interest rates, that spread widening is more likely to be dangerous for investment grade bonds than high yield bonds. High yield bonds are able to weather that widening better. And so we have an overweight to high yield over investment grade bonds.
And Anwiti, can I get your view on China? Do you have a specific sort of outlook there, given that latest economic data we're seeing?
Right, Andrew. I think China was one of the things that was keeping many investors away from emerging market equities. And our modest overweight in EM now is driven by that view that maybe we are seeing some bottoming in the Chinese stock market also. So again, a couple of evidence to point to that argument. One is clearly we have seen the latest data that's showing bottoming in the PMI data there also, but also we are seeing a little more effort from the policymakers on the housing front. We are seeing some more, I'm not sure whether I should call it strong stimulus, but we are seeing a little more attempt to put a backstop to what's happening on the property market. On top of that, one argument one can always make for that space is that valuations are actually quite appealing.
That is the view of Anwiti Bahuguna from Northern Trust Asset Management out of the States. Right, let's take a look at the local market. We are set for a positive start. SPI futures up more than 0.25%. In fact, the open is just a couple of minutes away. Stay with us for that.